Who are right now struggling, driving 15-year-old pickups, not because they choose to, but because they cannot afford to buy another, and is transferring it to those who can afford to pay $70,000 for a brand new F-150 electric pickup truck. Now, that's kind of a reverse Robin Hood.
Republican Bill Cassidy tells Bloomberg he'll vote no on the deal. We are learning about some new witnesses who've testified before the House Select Committee investigating January 6th, including members of former President Trump's cabinet.
The committee reportedly is zeroing in on members of the former president's inner circle and is particularly interested in learning more about conversations regarding invoking the 25th Amendment after the attack. Sources tell CNN the committee is negotiating terms for a potential interview with former Director of National Intelligence John Ratcliffe. They're also set to interview former Secretary of State Mike Pompeo as soon as this week. They've already interviewed former Treasury Secretary Steve Mnuchin and are interviewing White House Chief of Staff Mick Mulvaney today. In Washington, I'm Amy Morris, Bloomberg Radio.
And we've just learned the House has passed a bill to boost semiconductor industry and to counter China. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master, Tim Stanovic, live in our Bloomberg Interactive Brokers studio. The U.S. House of Representatives passing a bill that includes $52 billion in grants and incentives for domestic semiconductor manufacturing, now sending it to President Biden for his signature and delivering a win for the Biden administration more than a year after legislation was first introduced in Congress. David Weston saying to us, like, man, you know, President's been busy. He's getting stuff done.
Yeah, we talked to Ian King earlier this week for his story. Was that a Bloomberg Business Week story, Carol? Yeah, it's in the current issue of Bloomberg Business Week. And it's interesting because we've been talking about the CHIPS Act for a year at this point. And we said, what, $52 billion? It sounds like a significant sum of money. Ian, really contextualizing it for us.
I agree.
When you're a semiconductor company, $52 billion is like, okay, yeah, that's something, but we're spending a lot right now.
Isn't like, I forget what the number is that Intel's spending right now. Isn't it like multiple?
It was massive.
Yeah, I want to say.
So it was, I mean, it wasn't nothing, but it's, you know, it's not game changing.
No, exactly. And so you do wonder, putting into perspective, I do think it is important. I think many would argue, I don't know, there's the debate. We talked about like industrial policies, right? We see it in other countries like China and elsewhere where governments are actively involved in cultivating an industry or supporting an industry. So does this, you know, kind of sit at that juncture where it is a little bit of industrial policy, or is it a case of chips go in everything, including defense and communications? And many would argue that is our national security.
I would say the latter is.
I would too.
I mean, look at where chips are, right?
Yeah.
I mean, they're in everything from your smartphone to your refrigerator to vehicles. What do we hear from car companies that still have thousands of cars just sitting there waiting for chips. I mean, it's down because they've been able to get chips, but it's still thousands of vehicles that can't be sold.
So that's going on. Then we have President Biden's proposal to tax the unrealized gains of some of the richest Americans. That has taken legislative new form with a new bill from two House Democrats. So we're looking at maybe taxing billionaires. And then we're going to get into energy policy, climate, which is moving those alt energy stocks in today's session. We're going to do a Washington roundup in just a moment right here on Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A day after the Fed decision, equities are now at a 7-week high. The Dow, the S&P, NASDAQ all rallying. 43 minutes to go ahead of the closing bell. Let's head right over to the first word breaking news desk. And here he is, Bill Maloney.
And good afternoon, Charlie. It's all about earnings today and a bid for the main U.S. averages. Dow's currently up 357 points. S&P's gained 48, while NASDAQ is higher by 122. The U.S. 10-year yield at 2.68%. Gold is up 19. Oil is in the red. And Bitcoin trading higher by 4.5%. Among the main 11 S&P sectors, only telecom is in the red. And leaders to the upside in the Dow, Honeywell, Nike, and Microsoft, while Travelers and Intel led to the downside. After earnings, Stanley Black & Decker plunged 15%. Facebook was down 6%. And wrapping things up, Apple, Amazon, and Intel. I'll report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we're going to be busy. Bill Maloney, we thank you. And to hear live breaking news over your Bloomberg, type squawk, SQUAWK, on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Man, it's getting busy in Washington. We just talked about the CHIP Act. Looks like it's going to get ready for President Biden's signature. You've got billionaires, maybe a tax proposal. And then you've got also an energy policy bill that's all of a sudden made its way. What's
stuff
going
in
on?
Washington is happening?
Did they have spinach?
Hold
or
on.
have
What's
their
going on
Wheaties?
here?
What's going on?
And it's the summer, too.
Exactly.
Hey, let's get the latest from Laura Litvin, congressional reporter for Bloomberg News. She joins us on the phone from the Senate gallery where she is right now. So what's the deal, Laura, with the Senate and the House and lawmakers finally kicking into action?
Yeah, and this new energy climate plan that emerged yesterday with taxes was a real surprise. Even senators, you could see Democratic senators were not expecting this deal, which was basically a revival, had come out of a revival of talks by Majority Leader Chuck Schumer and Democratic Senator Joe Manchin that seemed like they had really fallen apart just a couple weeks ago on July 14th.
All right, so how do you get Senator Manchin, who was pretty definitive in not wanting to get behind this, how do you get him to do a 180?
It's very interesting because what I found in reporting this, a lot of this is Schumer and Manchin do have a good relationship and they've been talking for a long time. Schumer was very careful after the deal fell apart in mid-June, and he went for Schumer decided to go for like a bird in hand and some things that that Manchin would do, including a Medicare prescription drug proposal and extending ACA, Obamacare's premium subsidies for several years, and put off until later to see if they could do anything on climate. Schumer was very careful not to be critical of Manchin, but what was going on partly also was that a lot of other moderates in the Senate Democratic caucus I found were very skillfully kind of nudging Manchin back to the table. He's going to make his own decisions, but one that was very interesting to me was Chris Coons from Delaware, who is probably Joe Biden's closest ally in the Senate, went and sat down with Senator Manchin for 45 minutes just a few days after the talks fell apart, and also ran into Larry Summers, the well-known economist at a summit in Colorado.
Yeah.
Security Summit, and asked him, he knew that Manchin would like to talk to him about whether the package they were looking at would be inflationary, and Summers did not believe that, and really encouraged Summers to get in touch with Manchin. And there were some other things like this going on with some of these other colleagues who were trying to keep it positive with Manchin, even though he's faced a lot of attacks from progressives. And that was pretty significant. Manchin today spoke on a radio station back in his home state of West Virginia, and said one of the things that caused him to come back was really that he felt that the tax code isn't fair, and he wanted to see a few tax code changes happen. That includes a 15% corporate minimum tax for companies with a book value of $1 billion or more. He said also he was getting some agreement with the administration on some energy permitting changes that he wants to see that will move separately but are affecting the fossil fuel industries in very positive ways, and he wanted to see that happen. He said that had to happen to get this deal.
It's so interesting to hear, about the back and forth, especially the Larry Summers part of this. We should know Larry Summers, a contributor to Bloomberg Opinion, and oftentimes catch him on Wall Street Week with David Weston. Laura, I do wonder about the politics of this and what this means ahead of midterms, because when we see, big legislation like this, if it becomes law, it takes a long time for this stuff to go into effect in a lot of cases, or for Americans to see the results of it. We got midterms coming up, but we know what's on the mind of voters, thanks to polls, is inflation and gas prices.
You're absolutely right. That's the number one issue in all the polls. And I will tell you, Mitch McConnell, the first thing he said was, he put out a tweet the minute this came out saying that, Democrats had crushed American families with inflation, and now they want to take your job away. He said, first they killed your family's budget, now they want to kill your job too, because there's tax increases in this. And they're going to campaign on that in this package, in addition to what they're already campaigning on with inflation, and try and tie these two things together. For Democrats, it's beneficial, though, in that while you're absolutely right, it would take a long time for these provisions to take hold and to make a difference on things like the economy, the tax code. The fact is that it's a bigger package and gives them something more to campaign on.
Laura, I want to go back to something you said, though. How much of is it, Joe Manchin, the fossil fuel industry has been good for him politically in terms of contributions, right? And it's something that he has been very sensitive for a long time for many reasons. How much of getting this done was what you mentioned before about, some plans to ease rules that Manchin has said are constricting fossil fuel production and slowing, some upgrades to the power grid? How much of it is it that he does get something for the fossil fuel industry, while also moving climate initiatives forward as well?
Yeah, that's imperative for him as a politician, back in his home state, a coal state. He's used his leverage. This is a process that requires all 50 Democrats to stick together to pass this under they have the ability to avoid a filibuster, but every single one of the 50 Democrats must agree on something, and he has held back his support. This is one of the big things that he withheld for,
right,
is to make sure that fossil fuels are not being treated differently, that are not being pushed back by other types of energy forms. And you're seeing the parity in the chamber, and you're seeing Chuck Schumer struggling to deal with that.
It's amazing. Oh my gosh, though. Laura, thank you so much. I know this is all keeping you busy, and you carved out some time for us, which we are very appreciative of. Bloomberg News congressional reporter Laura Litton up on Capitol Hill from the Senate Gallery, joining us here on Bloomberg Business Week.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So a lot going on. We know that. We've talked generally when the big banks reported that M&A activity is down. But you know what? Spirit Airlines put a ring on it.
Yeah, but, I mean, we'll see if it happens, right?
Well, you don't think they're going to?
Okay, so Spirit and Frontier, that broke apart yesterday, but it's JetBlue and Spirit is what's supposedly going to happen now.
Dun, dun, dun. All right, we're going to talk about this with our own George Ferguson of Bloomberg Intelligence. He knows this industry so well. We'll get to him in just a moment.
And let's get over to Charlie Pellet for an update as we get less than a half hour to go.
Indeed, stocks higher across the board. 28 minutes to go before the closing bell, but worth pointing out that shares of Frontier right now, not happening for them in terms of that airline deal. Frontier surging 19.6%. Spirit up 4.7%. The acquired JetBlue, it is down now by about 1.9%. The Dow, the S&P, NASDAQ, we'll call it best level of the day right now with the S&P up 50, a gain there of about 1.3%. The Dow up 364, up 1.1%. NASDAQ up now by 129 points for the NASDAQ Composite Index. That is a gain of just about 1.08%. 10-year yield, 2.66%. We have got the 2-year yield, 2.86%. Spot gold up 1.2%, $17.54 the ounce. West Texas Intermediate crude is down 0.3%. WTI right now, 97.01 a barrel. Again, 27 minutes away from the latest numbers out of Apple. As for the global economic backdrop and how that could affect iPhone demand, Walter Piecyk is a partner at Lightshed Partners.
If you have economic weakness globally and you're trying to sell a $1,200 product, you can't just ignore that that's going to have some impact. There will be some mitigating factors, like, again, an operator willing to pay you to stay on their network or to switch over to your network. But that's still a pretty big headwind depending on how long this lasts.
Surprisingly positive results from Microsoft and Google parent Alphabet, also upping the ante for Apple. Apple shares up now by 0.3%. And reacting to last night's reports, we do have Microsoft shares trading higher by 3.2%. Meta Platforms, parent of Facebook, down now by 6%. Again, recapping the Dow, the S&P, NASDAQ, all advancing right now as we head toward the closing bell. S&P up now by 1.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Well, the sky's not so friendly as JetBlue and Frontier battled over buying deep discounter Spirit Airlines. The battle's over. As you know, JetBlue clinching a deal one day after Spirit called off a planned merger with Frontier. Well, today, Barry Biffle, he's the president and CEO of Frontier Airlines, telling Bloomberg, our own Katie Greifeld, about walking away from that deal with Spirit, but hinting it might not all be over.
Listen, I'm not going to speculate, but look, we're always looking for ways to save more consumers money. So I'm not going to close the door on it, but let's let them pursue their path, and we'll see how it goes.
Barry, JetBlue's calling the doors closed.
We'll see how it goes. That's what he said.
Exactly. Well, time will tell. Well, let's get to it with our own Bloomberg Intelligence senior aerospace, defense, and airlines analyst, George Ferguson. He's on the phone from New Jersey. George, so glad to have you back with Tim and myself. So are you surprised that it kind of went this way? And do you agree that maybe the door still might be open for Frontier?
So not surprised that it went this way. Really, I think after we saw JetBlue, up their proposals, I think if Frontier had more to bring, they would have brought it. And we just didn't see them bring anything, I think, significantly more to the deal to try to win it. And so it seemed to me that they were just trying to convince shareholders that in the long run, it was better to put Spirit together with Frontier. But they, again, weren't ready to bring cash. And so so I wasn't surprised. I thought it was interesting that I think we never really finally got a vote yesterday or a tally of a vote. So it just tells me that the shareholders just weren't going to be swayed.
Right.
I mean, there's definitely some discussion in the marketplace today that there are people that are worried that the DOJ, antitrust wouldn't let this go through. I don't see it. Like I don't see either of these airlines being so critical to the U.S. travel business that they couldn't let them, couldn't put them together. They're just not big enough. They're not.
Well, help us,
the country and us.
George. Help us understand sort of the test for regulators in a situation like this, because this is a highly regulated industry. So, what does Spirit and JetBlue? What do they have to prove to regulators in order for regulators to sign off on this?
Okay, so I'm gonna punt on this one because I have a colleague that spends all day long on the Hirschfeld whatever index that they use, and I'm just gonna say that they're gonna want to make sure that it doesn't mean that the industry is too concentrated and that consumers are going to pay a lot more for fares. And so again, I'm going to drop back on there are 4 major airlines in front of them: Southwest, American United, and Delta already. Right, have a huge amount of the marketplace. This is not going to be a lot of the marketplace. There's already competitors underneath the combined two. Alaska will be there, right? We'll have a growing Frontier underneath there. And the beauty of this industry is airlines are always being born. And so we got Breeze and Avelo and you name it. So
speaking of JetBlue, right?
And so I have a hard time imagining someone saying there isn't enough competition in this industry, because there's a heck of a lot of companies in this industry always working to take fares down on each other, always.
Yeah, I mean, right, this, the cycles of, tons of airline names, and then we see consolidation, and then we see more airline names, and then we see consolidation. Right, you've seen this movie several times before. I don't know if it's harder to get into it now. I don't know.
Even this quarter, if you think about it, the airlines are approaching 2019 levels of capacity, and they're nowhere near that level of profitability. Southwest did breach that today. They did a nice job. They said they see fares softening into 3Q. They guided much lower than their 2019 results. They aren't getting back all the increases in costs. It's a very competitive marketplace.
Hey, George, before we let you go, help us understand what a combined JetBlue Spirit would look like. It's going to be run by the CEO.
Tim just wants to know, are you going to get Mint on Spirit?
Yeah, there's no way. How do they do this? These are different cultures.
So I think they will. I think it's absolutely going the JetBlue direction. It'll be a kinder, gentler, low-cost carrier. I think you will get Mint on some of the routes, right? The routes where you can get people to pay up for. So they're going to have to reconfigure all the Spirit airplanes, repaint them all, and I think get everyone to be sort of kinder and gentler in their
redo those interiors, right?
Yep, that's a bunch of money involved.
Yeah,
that we put out a piece of research today, put some numbers on that.
Does it still just 10 seconds? Is it still though a discount, deep discount airline, or no?
Not deep discount. I think a discount, but not a deep discount. Maybe we'll call it a budget carrier.
Very interesting. Well, maybe then a little bit of a new strategy there for JetBlue. George Ferguson, we ran out of time. We wanted to talk a little bit about the air show in the UK, but we're going to have to bring you back for that because I'm just curious about some of the major trends going forward. George Ferguson, he's Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence, a must-read on the Bloomberg when it comes to all things in this industry. Thank you so much. This is Bloomberg.
Let's get to world and national news. Nancy Lyons is standing by in Washington, D.C. Hey, Nance.
Thanks, Tim. President Biden is welcoming the turnabout by Senator Joe Manchin that has revived a large part of his climate and economic proposals.
The compromise includes health insurance subsidies, Medicare negotiating drug prices, electric vehicle incentives, and a 15% minimum corporate tax.
I know it can sometimes seem like nothing gets done in Washington. The work of the government can be slow and frustrating and sometimes even infuriating. Then the hard work of hours and days and months pays off. History is made. Lives are changed.
The president added a postscript that 3.6% unemployment and record investment in manufacturing doesn't seem like a recession to him. In Washington, Irv Chapman, Bloomberg Radio.
In another victory for the Biden administration, the House has followed the Senate's lead and passed a $280 billion package to boost the semiconductor industry so that the U.S. can better compete with China. Well, President Biden and China's Xi Jinping held the 5th conversation of their presidencies today, speaking for more than 2 hours. Biden told Xi he supports the U.S.'s One China policy, recognizing only Beijing as the government of China, not Taipei. Veterans groups and Democratic lawmakers are blasting Senate Republicans for failing to pass a bill yesterday that would help the millions of veterans exposed to burn pits. Comedian and activist Jon Stewart says the defeat means more veterans will die.
They lived up to their oath. And yesterday, they spit on it. in abject cruelty.
Republicans expressed concerns with tracking how the money would be spent. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much, Nancy Lyons, in our 99.1 newsroom in Washington, D.C. Well, there is a headline just crossing the Bloomberg terminal. This is coming from Dow Jones Wall Street Journal. Instacart expects to go public before the year's end, according to people familiar with the matter. Earlier than many on Wall Street had expected, amid a frozen market for new listings. We've talked about the slowdown in the IPO market.
Yeah, it's been pretty remarkable because a year ago at this time, we were just talking about a blockbuster year for IPOs. M&A had really come back after the pandemic, but it's really frozen in the uncertainty about the economy and what the Fed is doing. But Carol, I think it's fair to call Instacart a tech company. I mean, you know, Instacart would call itself a tech company.
Definitely
Every
a tech
company wants to
element,
be.
right? And there's a tech backbone and infrastructure underneath it all in terms of how it operates.
Yeah, there absolutely is. We're going to get a good eye into what's going on with tech companies today, and consumer discretionary as well, when we hear about Amazon and Apple after the bell.
Yeah, Amazon, they're going to be reporting their second quarter results after the close. Analysts watching to see whether profits from the cloud computing division can basically offset slowing growth and rising costs in the central e-commerce business. I heard our Poonam Goyal of Bloomberg Intelligence talking specifically about the big thing is inflationary pressures.
Yeah.
And that has definitely impacted the bottom line, the top and bottom line, the increased costs, but definitely in terms of impacting the financial performance of Amazon. Certainly did last time around.
Yeah, the company is set to have a third consecutive quarter of single-digit sales growth. The expenses, Carol, have grown faster than revenue in the last 3 quarters, so the company's trying to realign by raising prices for Prime subscribers. We heard about that earlier this year. And then in Europe, imposing an inflation surcharge on online merchants.
Analysts projecting revenue will increase 6%. That would be a third consecutive quarter of single-digit sales growth. Don't forget, too, that was just earlier this month they talked about getting into healthcare.
Quick clarification, the raising prices for Prime subscribers, that's in the U.S. and Europe.
All right, well, good to know. And then let's not forget Apple. I love what you said yesterday. This caught my attention, too, in planning for Apple earnings. The share price surging in recent weeks, heading for its biggest monthly gain in about 2 years. We're talking about being up about 15% in July. Depending on those results today, that could maybe change that upward movement.
Yeah, sales growth at Apple has been slowing for 5 straight quarters, Carol, so we'll wait to hear from them, usually around 4:30.
Yeah, looking forward to that. All right, you're going to have it all right here on Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ all pushing higher. Do want to begin with a headline from the Bloomberg Professional Service. Instacart planning to go public by the end of this year. This according to the Wall Street Journal. S&P right now up 46, higher by 1.2%. Dow Industrials higher now by 343. That is a gain of 1.1%. NASDAQ up now by 120 points, an advance now of 1%. 10-year yield, 2.67%. The 2-year yield, 2.88%. Spot gold up 1.2%. Ounce of the precious metal now at $17.55 the ounce. And a retreat for crude, 97 even a barrel right now. West Texas Intermediate crude down by 0.3%. Big time earnings coming up after the close of trading today. We will be hearing from Apple. Those shares higher, little changed, up by less than 0.1%. Also reporting after the close of trading today, Amazon.com. Amazon shares up now by 0.8%. We've got you covered on those earnings. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. A redhead crossing the Bloomberg terminal. Biden and China's Xi directed aides to plan in-person meeting. An official saying that Biden did not discuss potential tariff steps with Xi and that they discussed concerns on unfair China economic practices.
And so this is, of course, building on the meeting that we know that they had earlier today, right? A
Yes,
conversation.
this is the call.
Yeah, exactly. So it's interesting to see that it's continuing on. All right, something we're monitoring, certainly, and we are monitoring as well also the markets. We'll get to that in just a moment.
It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. In close to 4 years in office, Brazilian President Jair Bolsonaro has done little to instill faith in his commitment to democracy. He's claimed only God could remove him from office, chipped away at checks and balances, and repeatedly questioned Brazil's well-established voting system. Whether such bluster could translate into a concerted effort to reject an unfavorable outcome in October's presidential election remains to be seen. But the mere possibility of an electoral crisis in Latin America's biggest country is one that corporate leaders should use their clout to prevent. Business coalitions and lobby groups can make clear the lasting economic harm that would be caused by any violations of basic democratic rules. Some have already signed an open letter in defense of democracy. That makes sense. After all, companies would have nothing to gain from the unraveling of the world's fourth largest democracy. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Yes, indeed, everybody. We are just about 9 minutes away from the closing bell on this Thursday. A lot going on, and we are seeing a rally underway, another risk trade, building on the gains that we got in yesterday's trade. I'm talking about the equity markets in particular. You heard Charlie talking about it. More than 1% gains on each of those major averages right now, Tim.
Yeah, I wonder if this is a bear market rally like our guest yesterday said, or if, it's here to stay.
Yeah.
Let's dig into the tech part of this with James Chalkmock, partner and a technology analyst at Clockwise Capital. James joining us on the phone from Miami this afternoon. James, good to have you back with us. It's been a while. How are you?
I'm well. Pleasure to be with you.
Well, let's talk tech because it's a sector that you watch really closely. Worst, is it behind us? I mean, we've gotten some important tech earnings this week. We've learned a lot. Is the worst behind us when it comes to the sell-off?
Well, I think what you can gather from this week's earnings, especially looking at the tech bellwethers like Microsoft and Google, is that the secular shifts that we're seeing on the digital and digital transformation side are far stronger than the macro pressures that we're seeing. And I think you're also seeing a bifurcation between the highest best of breed qualities that can weather the storm, the macro storm, and the companies that have been having micro issues that benefited from COVID, but now are having trouble gaining their footing once again. So, we remain optimistic. Obviously, the macro picture is something that no company is immune from, but at least gathering from the results that we've seen this week, there's certainly reason for optimism, especially given the valuations.
Okay, so help us understand which companies you consider sort of the leaders here versus which ones can't handle this new macroeconomic environment. I want to start with Meta Platforms, which is just can't get a break when it comes to shareholders. Is that one of the ones that's going to be left behind?
I think as it stands right now, if we look at it in a vacuum in July 2022, it looks like it will be. I think there are structural issues that the company needs to overcome. Now, granted, the comps will get easier next year once they anniversary the privacy changes over at Apple, but I think it's TBT. There are some bright spots with impressions growth in the teens, ad impressions, as well as the DAU number ticking up slightly higher. But at the end of the day, I think that's in the show me story camp as it stands right now.
Yeah, I mean, that's a potentially big shift in terms of their business, right? And so who knows, that story yet to be told. All right, when you look at some of the other names, I mean, what we got from Microsoft, was that kind of calming for you?
Absolutely. And I think one point on Meta is that I think the lesson learned is anytime you see a company change their name, you have to take a second look at it. I mean, we saw the same thing with Square changing to Block, right?
Yeah.
With respect to Microsoft, I think it was very encouraging. I think coming out of COVID, some companies are worse positioned. Some companies are positioned via the status quo. And some companies are better positioned. And I think Microsoft is definitely in the latter camp. The cloud services continue to drive the business. The adoption is there. And then you have new optionality, like on initiatives such as on the gaming side. So that's one that we like and we own.
What about, I just want to ask about Google before we start looking forward. Google also, how do you feel about that one?
Google, we like it, we own it. Not as much in size as some other companies, just given that advertising as discretionary as it is, that's one of the first things that pulled back. But the reading the tea leaves there, you can I think deduce that this is a company with first party data, unlike a Facebook, that can weather the macro storm a little bit better than others. And at the same time, you're seeing the strength of their platform, and I think the bright days are ahead for Google in terms of which companies will perform better, provide a better return over the next 6 months. I think there are other companies that will, but Google, our takeaway was certainly neutral to positive.
All right, let's talk Amazon, because last time you were on with us, James, it was back in April. You said that Amazon has more levers than any other mega cap out there. You said that you liked it. Has your opinion on Amazon changed at all? And we reminder, in just a few minutes, we're going to hear from the company on its latest report.
No, the opinion on the company hasn't changed. I think, if we had to look back and about our positioning at that point, probably underappreciated the Fed's influence, on the market. But structurally speaking, the company is certainly more sound than it's ever been. And I think you can argue that a lot of these companies, Amazon included, have come out of COVID, come out of managing this macro issues and managing the inflationary issues better than they would have otherwise. So I think the companies are stronger and more nimble and more agile as a result of this. And I think for the quarter, we've seen retail results, mixed bag there, but, top line possibly, under pressure because of the macro. And the bottom line, they're working through the cost changes. But as we look forward into 3Q in the back half of this year, I think that's where you're going to see the leverage that we talked about last time come to fruition. So we remain very bullish on Amazon, and it remains our largest position.
Yeah, I think about whether it's an Apple or an Amazon, how much they are entrenched in my world personally. And when I go to buy something, how quickly I go to Amazon because I kind of know. And I just, for the first time, actually went to a locker, had something delivered, and it was like such a great positive experience.
Great news. You're going to get to go to Dr. Amazon soon.
I don't know about that. Hey, James, real quickly, 10 seconds. If Amazon comes in weak, is that a buying opportunity? Very quickly, please.
yes. I mean, in short, yes, absolutely.
I know you can be quick. Thank you so much. We love talking
We
with
still
you.
had like 10 extra seconds for you too, James. That's
No,
good.
we don't actually. We got to run. James Chakmak, he's partner and tech analyst over at Clockwise Capital, joining us on the phone from Miami. All right, folks, we've just got a few minutes left in today's trading session. We are seeing stocks trade near their best levels of the session. S&P 500 up more than 1%. Dow just about a 1% gain. And same story for the NASDAQ. Right now it is up 1%, but get ready. We got some big earnings coming. Amazon, Apple, Intel. We will be breaking them down after the closing bell, watching that market reaction. Time now to head over to our TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Shonali Bassett, counting you down to the closing bell. Here to help you take Beyond the Bell, as always, with our global simulcasters, Carol Massa, Tim Stenevik. We go cross-audience, TV, radio, YouTube, to dissect a world where economic data collides with politics, and we see Chuck Schumer saying that he believes the climate tax deal will pass before the August recess. So really so much to be digesting on today on what takes this market higher.
It's amazing, right? Whether it's Washington or Wall Street or Main Street, there is so much coming at investors at this point. What's going to come at us in just a few minutes, we're talking about Apple earnings as well as Amazon earnings. We just talked with James Chakmak over at Clockwise Capital. He said if we even see some weakness in that Amazon report and the stock trading lower, to him, he already owns Amazon. He said that would be a buying opportunity.
Yeah, he said that this week it really showed us the companies that emerge as the leaders post-pandemic, and he would put Meta Platforms in one that actually doesn't, reminding us that, when a company changes its name this far in, perhaps there's some confusion on what their goal is. But Microsoft and Google, he said, those are going to emerge stronger.
Yeah, it'll be interesting to see how certain companies emerge after the earnings today, with some such pivotal ones coming out. The after-hours movement today should be just as interesting as the current movement in the markets, setting up for the best 2 days off a Fed hike, at least since 1980, according to our producer, Dan Curtis, and my favorite boss.
Dan, here's you. We mentioned Pete, our other favorite producer, so much that Dan weighs in to get a shout out as well. But yeah, a significant rally, Caroline, that statistic represents when you're thinking about some of the big Fed moves that have really been largely to the downside. Today is a reversal of that.
Yeah, no second day fade into the on-the-day rally today. We're up 1.2%, 48. So almost 47 points higher as we get settlement, as we get the ringing in the bells and the shouting and jubilation. We see volumes up significantly on the S&P, almost 20% higher versus your usual average. And we see the S&P up, as I say, about 48 points, 1.2% higher. And the NASDAQ up 1.1% higher. That's 130 points on the upside. And actually, volumes higher, but only by about 7%. Dow Jones up more than a percentage point, and that had big volumes of about 13% higher. And the Russell 2000, not to be left behind, up 1.3%. Actually, your outperformer of choice today, Carol.
Yeah, absolutely. And those are outperformers, and also those solar stocks. If you take a look at all the alternative energy, again, an outperformer. Caroline, you mentioned the legislation and things that are making their way through Washington, and that is certainly having an impact.
Yeah, we have to look at the sectors also, what is having an impact the most, because you're looking at real estate, utilities, communications, and professional services rise almost 3% or more. You had the S&P rising about 1%, but some sectors here getting a really healthy bid. And you do see, with traders coming back into the market with some breath, you are seeing a lot of green on the screen.
I'm just going to weigh in because Amazon is giving its numbers, and net sales coming in at $121.2 billion. Now, that is a beat versus the 119 just. It's giving us a forecast, though, of $125 to $130 billion for third quarter net sales. That's actually basically higher than expectations of $126, $127 billion that the street wanted to see. Their operating income coming in strong, $3.3 billion, again ahead of expectations. Online stores net sales slightly shy of expectations, about $51 billion. Their North American net sales doing well, $74 billion. Physical store net sales, remember, of course, is Amazon Go that we have a lot of here in Midtown, $4.7 billion. And the subscription services net sales, $8.7 billion, slightly shy. Overall operating margin that is stronger, 2.7% than the market had seen at 1.65%. But they do talk about unfavorable impact from the dollar, 390 basis points, so 3.9% overall. Taylor.
Yeah, I mean, so similar, Caroline, when you think about some of the forecasts. I know that we want to stick with Amazon, but we're also getting Intel earnings as well. And the CEO saying that we must and we will do better, that this quarter's been below the standards that we've set for the company. They are reiterating their year in terms of adjusted free cash flow, but they're looking at now adjusted revenue of just 65 to 68 billion. Previously, these estimates were $76 billion. So really seeing a big slowdown here, Carol, when it comes from Intel, as we take a look at some chip makers outside of the world of Amazon.
Yeah, and it's really playing out in that Intel share price here in the aftermarket, down more than 5% as we speak. But going in the other direction, let's go back to the big one also. Amazon now up about 7.6%. And we did see three-quarter net sales, so it's talking about the outlook, 125 to 130 billion. So it's bumping up some of the estimates that are out there on the street. The overall estimate, according to Bloomberg, is 126.97 billion for the third quarter. So that, to me, Tim, says pretty strong consumption in terms of what consumers might be doing at Amazon.
Yeah, some interesting commentary coming from Amazon CEO Andy Jassy in the press release. He says that, quote, despite continued inflationary pressures in fuel, energy, and transportation costs, we are making progress on the more controllable costs we referenced last quarter, particularly improving the productivity of our fulfillment network. He continued by saying that we're also seeing revenue accelerate as we continue to make Prime even better for members, both investing in faster shipping speeds and adding unique benefits such as free delivery for Grubhub for a year and more. Remember, they announced just a few months ago that the Prime price would go up here in the U.S. and in Europe.
All right, that third quarter revenue really kicking up shares of Amazon higher in the after hours, now up about 8.7%. Let's go to our Poonam Goyal of our Bloomberg Intelligence team. She's a senior industry analyst covering retail. So, Poonam, you were worried about inflation and pressures on Amazon. This looks like a pretty good report.
It actually is a very good report. In fact, we were worried about inflation as Amazon had said that there would be an additional $4 billion in costs for the second quarter, but we were not worried about what we saw earlier this week with Walmart taking down guidance, as we had thought that Amazon has a different customer base. Amazon doesn't target the low-income consumer, so we didn't think Walmart's woes would bleed into Amazon, and that's exactly what we saw today. Sales are better. The guidance is actually really good for the mid-teen sales increase next quarter. Part of that is driven by the Prime Day shift, but it also shows that the customer is spending where they find value and convenience and speed.
Talk to us about how they're managing their own costs, because we did hear from the commentary, and we'll get more of it on the call from Andy Jassy, saying, look, despite these headwinds of inflation and indeed a concerned consumer, they're managed to control their own costs. How are they doing that?
Well, part of that is because they have their own delivery network, right? So they can tailor those costs. They can use computers and systems to better align delivery methods and really help bring those costs down. That said, we don't have the full details yet, and we hope to get them all on the call later today about how much of that $6 billion in incremental cost, of which $4 billion was expected in 2Q, how much of that will be persistent in the back half of the year, or have they gone through most or half of it?
I'm really interested in some of the other things that Amazon is doing here. You're seeing AWS net sales also beat analyst expectations here. You're seeing Andy Jassy's first quote really talk a lot about some of these other things that they're doing. Thursday Night Football, delivery from Grubhub. This is rare in this kind of environment to see CEOs speak about a little bit more moonshot projects here. So how much do we expect Amazon to really grow and expand given all of these other pressures that
Yeah, I think, the misconception that Amazon is mature across any of its businesses is incorrect. Amazon has plenty of opportunity to grow its online business as well as AWS advertising and media. The recent news that we saw on Amazon, whether it was through Grubhub or even in healthcare, just shows that there's so much opportunity ahead for Amazon. They're just tapping the surface. And when they increase that Prime membership fee, which they did earlier this year, people are still sticking with it just because of all the value that they get with the Prime membership fee.
Hey, Poonam, how come such a beat when it comes to operating margin here? Estimates were for 1.65%. It came in at 2.7%. Where is Amazon able to control these costs in an inflationary environment?
I'm very interested in hearing what they say about where they actually control those costs. My guess would be AWS definitely helped contribute to some of that, but also perhaps it might be on the transportation front where they do have their own delivery network. But we're waiting to hear, just as you are. We don't have the detail there, but it looks like they may not have exhausted all their cost savings earlier and they found some extra.
does that continue when they're looking at third quarter operating income that could be flat? And I'm curious if this is an investor base that is prepared to maybe see lower profits, to go back to maybe the original company that we knew, a heavy investment in their own business, instead of maybe returning some of that to shareholders. Is that sort of an investor base that is prepared for that pivot? Do you see that?
I think Amazon should continue to and will continue to invest in the business, because keep in mind, many of their businesses are still very young, whether that's AWS, whether that's advertising, whether that's media, or even early investments into grocery and pharmacy, which are really nascent when you think about their online penetration. So there will be a lot more investments going forward. That said, on the profitability part, if their sales grow in the mid-teens next quarter, that also provides them with leverage, right? It's much higher than what we saw in the second quarter. So you should see profits expand over time. And when I say over time, it's the long run, right? Right now, Amazon is still investing, but they do have very lucrative, very high margin businesses that are still young in nature. In fact, AWS alone, we think margins could at some point reach 40%, and that contributes to more than 2/3 of their operating profit.
We're talking with Poonam Goyal of our Bloomberg Intelligence team. She follows retail. She follows Amazon. Let's just remind everybody that Amazon shares are up almost 12% here in the aftermarket. And in particular, that's because the company came out and said its third quarter net sales, the forecast for the third quarter, 125 to 130 billion. The estimate out there is 126.97. So they're bumping that up. All right. So you're sitting down with the executives. I always like to ask these kinds of questions of you, Poonam. What do you ask the company? Because it does feel like they are doing really, really well managing the business and also exploring into new businesses.
Yeah, the one question that's on top of my mind right now is the excess capacity that they've built and where we are on that. How long will it take to fill into that capacity or maybe lease it out? Because that is still a concern. And they are building more warehouses as we speak. I saw something come across the newswire earlier where, they're building bigger centers in key cities. So where is all this capacity actually going?
Poonam Goyal, of course, our senior retail analyst for Bloomberg Intelligence. Really appreciate it. As you're taking a look at Amazon, shares are up about 12% after hour. We take the reverse of that, Intel off about 9-10% or so in post-market. And some really interesting comments. Of course, the numbers, and I'll get through these here. The second quarter adjusted revenue, $15.3 billion, estimates for $17.9. So really missing estimates by almost $3 billion or so. You have a full year adjusted revenue as well, guiding way lower, $65 to $68 billion. Previously had seen estimates of about $76 billion. So you do have the CEO, Pat Gelsinger, coming out and saying that we will do better, that we are looking for our free cash flow guidance to be reiterated, but really talking about accelerating their deployment of a smart capital strategy, a market, at least for now, that is not buying it. Given some of the numbers, the third quarter, again, adjusted EPS on the bottom line, about half of the expectations, 35 cents versus estimates of 82 cents. Let's dig through all of the different numbers and the comments we're getting from the CEO and bring in Mandeep Singh, senior technology analyst here for Bloomberg Intelligence. And Mandeep, curious what you think about these numbers.
Well, when a company comes out and revises its guidance downward by 15%, we're talking about top line here. You look at their Q1 print, they guided to 76 billion, and now they're talking about 65 to 68. So clearly a lot has gone wrong over the course of the last 3 months, and it just puts into question the credibility of this new management. What changed so much that they had to guide down by 15%, and on a gross margin and operating margin, they came down almost 10 percentage points below what they guided to? I mean, this is a clunker of a quarter. I can't find any other word to describe it, but this is as bad as it gets for Intel.
As bad as it gets, a clunker of a quarter, Mandeep. I want to go back to what Pat Gelsinger said in the press release. The quarter's results were below the standards we have set for the company and our shareholders. We must and will do better. I want to point out this part, though. He said the sudden and rapid decline in economic activity was the largest driver, but the shortfall also reflects our own execution issues. Given what we know about what the other chip companies have said thus far, we've learned about them. What are the economic issues that he's describing here? Because the execution is certainly part of it, and he admits that, but the macroeconomic environment is a big part of that. So how should we read into these earnings to get an understanding of the global economy right now?
I mean, Tim, Qualcomm reported last night they grew 37%, guided to 22% growth, and granted, Qualcomm is more exposed to smartphones and 5G. But they also diversified their exposure to automotive, high performance computing, hyperscale cloud. Intel talked about all these things in their analyst day, a couple of months back, and that's what they said they were pivoting to. So what changed so much that suddenly they have to guide down by 15%, and they lost all the pricing power? I mean, look at the gross margin compression here. Yeah. They're really taking a hit on their pricing. So I don't think anything can, justify the kind of guidance that they have taken down here. And to me, this is, yes, execution issues, but also Intel is losing share, and they're losing share to AMD, to NVIDIA, to Qualcomm, and to TSMC on the foundry side.
Talk about the foundry side, because today we do understand the CHIPS Act has gone through. $52 billion is something that Pat Gelsinger was going to be using the money for, digging in Ohio, new fabs. But is that the right tactic right now, Mandeep?
Well, so the thing about building new fabs is it's a multi-year investment. Yes, I think when a government gets involved and supports an industry, it's a good thing. I think overall it's a good thing for all the semiconductor makers here. The problem is setting up a fab, getting it up and running, having the production going will take 4 or 5 years. And a lot can transpire between now and then. And all the fabless companies that are relying on TSMC for the latest nodes, they will take share here. AMD will take share because they're using TSMC's 5 nanometer, and their chips are much better right now than what Intel has on the market.
Let's remind everybody, Intel shares are down 8.4% in the after hours. I can't get away from the CEO saying we must and will do better. All right, so Mandeep, does this company need to be worried about an activist investor saying, yeah, you do need to do better and we need new management?
Well, so clearly, I think this puts into question the credibility of the management. And look, there are no easy fixes here. The good thing is government is behind Intel and the entire, U.S. chip industry. So that is a positive. The question is, how can they pivot to the right areas? They talked about that in their analyst day, getting into GPUs and getting into more system on a chip, pivoting away from their core CPUs. But that execution isn't showing. So a lot has to show up in execution over the course of the next few quarters.
A big thank you to Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence. Caroline, I know you got your eye on a couple of other companies, Roku among them, slumping more than 20% in the after hours.
Yeah,
there's a slowdown hitting results.
Great function on the Bloomberg, most, and you can see what are the biggest movers after hours. And Roku caught my eye because the volume was significant as well. The video streaming platform, we know it, and they're talking about a slowdown in TV advertised spend that is hitting them overall. Therefore, we got third quarter revenue forecast that was below the analyst expectations. They were losing on the second quarter in terms of missing estimates, really. They see a net revenue of $700 million, and the market had wanted to see more than $900 million for their net revenue overall. The EBITDA loss they see on an adjusted basis is $75 million. The estimate had been for a profit of $25 million in the third quarter. Gross profit coming at $325. This is a company that, on an earnings per share basis, is posting 82 cents in the second quarter. And at least that, the market had seen some sort of loss there, but really net revenues not growing as much as had been hoped for. And I think this speaks once again to where companies are going to be spending their marketing dollars. Not on Roku for the time being. We saw the weakness in Meta, and indeed it's interesting where others has been hit overall. We want to do all of these earnings really and dig in a little bit more to the worlds of Amazon and Intel as well with Ted Mortonson. He's with us, technology strategist at Baird. Ted, go back to the juggernauts here because Amazon is significantly flying after hours, Intel pulling back after hours. What stood out for you in terms of these earnings after the bell?
Well, I think you can see that Amazon's got tremendous scale. And I think also if you look at that scale and how management is kind of readjusting the infrastructure from an OpEx standpoint, these results are definitely better than feared post the Shopify print earlier in the week, as well as the Walmart data. So if you look at the results on Amazon, I think North America looks a lot better. We were at 119 billion. They actually obviously did better. Operating margin came in better than feared, and the guide is within expectations. The other thing is, if you look at their model, they have two big op margin drivers. One is their advertising business that looks solid. They don't break out the operating margin contribution, but it is meaningful. And then AWS, if you go back to the Microsoft prints as well as the Google prints, if you look at Microsoft, they grew AWS almost 46%, and Google grew GCP about 36%. AWS is slightly above where the street was, at least for that expectations. They're the #1 player with tremendous operating leverage versus other players at around 35%. So yeah, they're operating in a very difficult consumer environment, but managing through it pretty effectively.
From operating environment to execution here, you're looking at that steep drop-off in Intel aftermarket after reporting, and they do respond to the challenging business environment, but they also say they just were not executing. So to what extent is this a single stock story now? If the managers are not able to rake in as much top line as they can here, what kind of predicament are they into for the rest of the year?
Well, they've had tremendous share losses on the server side just because AMD has a better design. The other thing I think is if you look at the consumer PC market, that end market has definitely decelerated the last 6 months, and Intel derives around 50% of their revenues from that compute area. And then in the data center, they just are, quite frankly, just not positioned where AMD is, and AMD continues to take some massive share. I think Pat is still trying to catch up from an engineering standpoint. If you look at TSM at the 5 and 7 nanometer nodes, they're operating essentially on all cylinders. Intel's trying to catch up on a node generation, and that really hamstrings them on some of the next generation server infrastructure chips that they have that have been pushed, like Sapphire Rapids. So all around, they're just not executing. And I think the magnitude of the miss is much greater than the street was looking for. Now, with that said, there are some people looking at Intel as a national asset now, post the CHIP Act. And that's the only saving grace, really, in the next couple quarters for the company.
I am curious, in your coverage universe, what do you notice about companies like Amazon who are just setting the standard, setting themselves apart from everyone else? Is it their pricing power? Is it the ability to invest in themselves to get 2-day shipping? What is it that company is doing that sets them apart?
Well, if you look at Amazon, their roots come from AWS, right? And if you look at all of the AI and the machine learning that they have embedded across the organization, whether it be automation in their warehouses versus people, that's where they're pushing. They have tremendous operating margin leverage. And I think if you look forward, at some point, all of this investment in fulfillment and all of that $1 billion investment in COVID that will hopefully disappear at one point. And then if you get a more of a moderated inflation area. Last quarter, inflation cost the company a couple $2 billion. So if you look out further and look at their scale, the operating leverage of the company is very, very powerful. Now, who can compete with Amazon at this point? They've created this massive infrastructure that is extremely scalable when rates were basically zero and the capital markets were open. That advantage is only going to multiply from almost a monopolistic leverage standpoint for anybody that's trying to compete with them.
Hey, Ted, I want to go back to something you said about Amazon and advertising and get an understanding from you about how Amazon is positioned in an environment where marketers are pulling back. I mean, we saw what happened with Snap. We saw what happened with Meta Platforms. Certainly Alphabet, a different story when it comes to advertising. But where's Amazon positioned right now, given that it operates in kind of this different space and perhaps the changes that Apple made to its iOS ecosystem don't hit it as hard?
That's a great question. I think as you look at how they've structured their advertising, they're almost captive to their own eco-structure on e-commerce. So are they really affected by IDFA? No. I mean, they can look at their entire consumer base and use AI and machine learning to source advertising. This is an advantage not only for Google, Amazon, even Apple as they roll out their advertising. The companies that are having trouble obviously Pinterest or a Snap or a Meta didn't have that captive data stream from their own networks. And I think this is a big advantage for Amazon going forward as they leverage their machine learning and AI capabilities into that core commerce engine. They're going to be a pretty powerful player in advertising. It's now becoming a meaningful part of revenue and operating margin. They don't break the operating margin contribution, but it's definitely a driver.
All right, going to leave it on that note. Ted, thanks so much. We really appreciate all your input. Ted Mortensen, he's tech strategist at Baird, joining us there from Milwaukee. Just to rehash, folks, Amazon rallying big time, up about 12% in the after hours with an upbeat third quarter revenue forecast. Intel going in the other direction. We're seeing it sell off about 11% here in the after hours. It talks down its third quarter adjusted revenue looking forward. And then you've got Roku down almost 27% in the after hours. So some big disappointment in terms of that company's third quarter outlook as well as its second quarter numbers. So let's also looking forward to Apple, which should be crossing in just a few minutes. Julie Ask is with us. She's Vice President and Principal Analyst of Consumer Tech over at Forrester. She joins us on the phone from San Francisco and actually on the camera as well. So, Julie, a lot of tech earnings, a lot of big names that are very important, not only to the financial markets, but really to the overall economy and some of the big macro issues of our time. What's front and center for you for Apple when it reports?
So I think, well, first, thank you for having me. So I think we'll see what happens. I think with a lot of companies selling to consumers, they face a lot of headwinds. There's a lot of consumer uncertainty. We may be facing a recession. There's increasing interest rates. There's supply chain issues. So I think there's a lot of headwinds all the way around. I think one of the things we always think about, though, when we look at Apple, is they do have a more affluent customer base than most brands do. If you look at the mean household income of, let's say, an Android smartphone owner, it's about closer to $70,000 in the United States versus about $88,000 for Apple. So it's, like 35% of Apple smartphone owners have a household income of more than $100,000 a year. So Apple's got some things that play in its favor, even if we see a downturn here in the economy.
What about the ecosystem here, Julian, when it comes to switching costs? Because when people don't just switch between iPhones and Android phones, because they create, this network when it comes to their own personal devices. So I'm wondering how essential these Apple devices are in an environment where people are paying more for gas, they're paying more for food. Are they going to pull back on spending on that premium device? Are they going to switch down to an Android device? Or is Apple's ecosystem so powerful that it becomes like a utility?
I think it's a really good point, Paul. And it's, there's a bit of, we'll see. I mean, yes, we likely will see consumers do pull back on some spending, but I think there's a number of things that play in Apple's favor. When we talk to consumers and survey online consumers in the United States, Apple is the #1 consumer electronics device brand that they own. It's even the case that 18% of consumers we survey only own Apple devices, so they're really locked into that ecosystem that you're describing. Apple has also been very smart about creating an ecosystem of services that work, very seamlessly across their devices. So if anyone's well positioned to hold on to their consumers during this time, I think it's Apple.
Julie, Tim talks to us about sort of the ecosystem of an Apple. I want to go a little bit outside of Apple and more the ecosystem of tech and big corporations right now, because we are hearing from Chuck Schumer, of course, and majority leader in the Senate, about taxes going up for big companies. Is this a headwind longer term? Do you think a 15% minimum tax rate is going to implicate some of these big tech companies?
So it's hard to say. I'm not an economist and I'm not a financial analyst. I think, when we think about corporate taxes too, I think it's a bit of a headwind. But then what also comes into play is, creating some parity throughout the world with where companies are headquartered, where they're hiring talent. And so I don't see that necessarily as a short-term impact, but it could have a longer-term impact, more broadly on how their organization is run.
How do you think also more broadly on some of the comments we've heard about dollar strength and the impact that it means on the business and the balance sheet? Is that less worrisome because they're not talking about the fundamentals of the consumer? They're just talking about things out of their control, a la strong dollar.
Yeah, so I think, like I said, it's a little harder for me to comment there just because I said I'm not a financial analyst. But Apple is always strong. It's got a huge balance. It's got a large cash base. They've always been very savvy. So while I do believe all of these headwinds will impact all corporations, I think from our perspective, Apple is a little bit more buffered from that than perhaps some of its competitors.
How much is the devil in the timing here? Bloomberg's Mark Gurman watches this like a hawk, and he notes that this is typically a slow quarter. There weren't any major new product releases. The developer conference said there would be new MacBook Air models, but they didn't go on sale in June. So what are we looking at to drive sales in this current release?
So I'd say I think there's two things to look at. So the first is comparing any quarter to the past 2 years is really hard. The pandemic's kind of over. Consumers are back to work. They're not at home. So I would expect to see a dip in things like services, the amount of media we're consuming, the amount of devices that we're having at home. So I think that's, certainly that's one element of it. But it's,
Julie, I want to go back to, obviously when we think about the consumer, and we've heard this a lot today in terms of preparation for Apple's results, that they are a higher end consumer, and the higher end consumer has been holding up, right? We've seen reports from Walmart, so we're seeing what's happening kind of at the lower end, and certainly those consumers are getting squeezed big time. In general, if we see a disappointment, what does it tell you then more broadly about our economic outlook here?
Yeah, so like I said, I think that's hard to say. It's really hard to compare to the past 2 years. I think, one of the upsides, it's, that's very specific. I mean, if you keep in mind that almost 2/3 of Apple's revenue come from its smartphones, people do replace smartphones more frequently. The upgrade cycle is certainly faster than it is for a PC and for tablets and some of the other devices. So that also plays in their favor. So like I said, it's hard for me to predict what they're going to announce in about a half hour, but it's, like I said, there are some things that they do that buffer them that other companies don't have in place.
All right, Julie Ask, Vice President of Principal Research of Consumer Tech at Forrester, joining us from San Francisco. Julie, thanks so much for taking the time. Hey, let's go back to Amazon and talk a little bit because we just got a couple minutes until Apple comes out, but Amazon shares still up more than 11% in the after hours. Second quarter sales topping analyst estimates at $121.2 billion. AWS Cloud Unit sales of $19.74 billion, beating estimates, though operating expenses coming in at $117.9 billion, below expectations. So a win there as well.
NASDAQ futures rise 1.7% as we await to see if the trade carries on through tomorrow. Another, though, big heavyweight, Caroline. I know that, of course, as we wrap up Amazon and push forward to Apple as well, when you think about not only the market cap of this company, but the read on the consumer, chips, supply chain, China, you name it.
Yeah, inflationary headwinds, the strength of the consumer, and also the strength of the share prices of late. Amazon's move is so notable because it had rallied so hard before this. All of these tech companies had a great July. Let's get to the Apple numbers. They're breaking now, and we are overall seeing, well, an earnings per share number that comes in with sales $82.95 billion and indeed an earnings per share of $1.20. Now, this is a company that's seeing Mac revenue just shy of expectations, product revenue of $63.36 billion. That's a beat overall. iPad revenue is beating, and we are seeing overall like decent revenue numbers of $83 billion, just ahead of expectations. And the board has declared a cash dividend of 23 cents per share, generating about $23 billion in operating cash flow during the quarter. We've already been hearing from Tim Cook, thanks to our own Emily Chang. Let's get to her, Bloomberg Technology Anchor. And Emily, what did Tim Cook say to you about these numbers?
Hey there, Caroline. I did just get off the phone with Apple CEO Tim Cook. And, look, he was optimistic about the demand that they're seeing in the quarter ahead. Just like you said, we're seeing a revenue beat here, and we're seeing iPhone demand remain strong, which speaks to what we heard from Qualcomm yesterday, that demand for the high-end part of the smartphone business is still strong. He also talked about iPad demand still being strong as well, but that supply constraints really face the iPad and the Mac, and you're seeing that in the numbers. In terms of the macroeconomic factors at play, he didn't suggest that that has had anything to do or any impact on demand, except in wearables. My interpretation of that is that, these are more discretionary items, and because of inflation, because of consumers feeling under pressure, that's not necessarily where they're going to choose to spend their money. He mentioned FX multiple times. It's a theme we've heard from a number of these CEOs, from my call with CFO of Alphabet, Ruth Porat, earlier in the week, that if in constant currency, Apple would have grown 5% instead of the 2% that we're seeing. Now, this was the key headline in my conversation with him. In my opinion, he said, they do expect revenue to accelerate in the September quarter, despite seeing some softness in some areas. We do believe there were some macro headwinds that affected the business in the June quarter, which I already discussed. But despite these headwinds, they're expecting revenue in the current quarter to accelerate.
Hey, Emily, it's Carol here. I'm curious too. We know, Apple among those companies within the big tech universe where we've heard things about slowing of hiring and slowing of spending across some of the teams at a various company. We heard it from Apple. Anything on that front?
Yes, well, of course, we've got reporting from our own Mark Gurman that Apple plans to slow spending and hiring across some teams next year. I asked Tim Cook about this, and he said it this way. He said, we believe in investing in downturns, so we've always done that. They found that's made them stronger on the other side. He said, obviously, we're being deliberate in our decisions of where to invest. So a nod to this plan to slow hiring and spending across some teams next year. But, I would say this is not the same, direness or dire level of warning that we've seen from other companies. For example, Alphabet is slowing hiring now. Other companies are doing layoffs. That's not happening at Apple just yet.
Emily, I think it's really important that you mention that next year outlook, because all over this statement, records still being hit, $23 billion in operating cash flow being highlighted, $28 billion of capital return to shareholders, investing still in long-term growth. So to the extent there is some bad news here, you're seeing beats and the shares pop after hours a bit, to the extent there is bad news that could bleed into the coming quarters that analysts and investors will be looking for, what would that still be?
I think there are probably still challenges on the supply side, but if you'll remember in the last quarter, Apple said, you can take $4 to $8 billion off the top just because of supply chain issues that we're going to face. He said, actually, that came in lower than the low end of that range ultimately, and he said, quote, we saw significant improvement in the month of June in China on the supply side and on the demand side. He specifically referenced the June shopping festival holiday in China, saying they had really strong results there. And as we've reported, they're actually starting a promotion in China tomorrow for a few days across a few different Apple devices, which is it's very rare to see a discount like this on Apple products in China. And I asked him for the reasoning there, and he said, look, there's lots of reasons to do with promotions, but it has zero to do with clearing inventory. So we can take from that what you will. But a generally optimistic and upbeat tone from Tim Cook, especially on the supply side, that they have seen significant improvement.
Okay, well, good. Let's talk more there and talk more about China, Emily. And just to give us an idea of what you learned from Tim Cook about supply challenges in China, because, look, China's an incredibly important market to Apple, not just when it comes to sales, but also when it comes to manufacturing of many of these devices. So what do you know about how continued lockdowns have affected sales, or continued lockdowns have affected actual supply of these products? What else did we get?
I think the word is improvement, and that it was better than they thought it would be, right? They said it would be, they could lose potentially $4 to $8 billion because of these issues. In fact, it was less than the $4 billion that they expected. And, Tim Cook never gives any indication about what's coming in the quarter and the quarters ahead. He very much wants to talk about the last quarter and the results that they've already seen, but it's definitely more, I believe we're hearing a more optimistic tone than we've heard from other CEOs.
Not lost on us, Emily, that it's also coming when we're getting a CHIPS bill, a CHIPS Act, about $52 billion of a bill that was sent to the president for his signature. Apple is a company that has tried to build that moat around itself, working on that M1 chip, the M2. How are you thinking about a company that is trying to become more self-sustaining?
He did mention the M2, said they're very excited about it, very proud of the impact that it's already having and will continue to have. And I think it's certainly part of Apple's long-term strategy. And, as we know, Tim Cook is the architect of Apple's supply chain. And so he, personally knows how difficult it can be to procure the right supply when you need it, and certainly in these times. And so I think building and designing its own chips just makes Apple, more independent, more self-sufficient in times of economic downturn. And I think the hope, for some investors, we've seen Apple shares rise or outpace their peers like Alphabet and Microsoft in the current macroeconomic environment. And the hope is that Apple, even though it will be impacted by a downturn, might be more of a safe bet in a downturn.
Really appreciate it. Our very own Emily Chang. Make sure to stay tuned. Catch her coming up in just a few moments' time as well for that show, Bloomberg Technology. We want to stay with Apple, dig deeper into these numbers with our very own Bloomberg Intelligence Senior Software and IT Services Analyst, Anurag Rana. Anurag, curveball, why aren't we getting forward guidance? Do we need forward guidance from this company that was paused during COVID?
We should, but as we heard, there are so much of things that's still uncertain about the supply chain, about openings in China. But I was very happy to hear the comments that came from Emily because I went into the quarter a lot more pessimistic than most people because I thought because of the consumer slowdown, because of China, because of Europe, we will not likely to see this kind of a beat that we saw at least going into next quarter.
Of course, Tim Cook talking about macroeconomic headwinds hurting the third quarter, expecting revenue to accelerate in their fiscal fourth quarter despite some softness. Anurag, where do you think has been firing on all cylinders? Clearly, the iPhone has been. It was notable that there wasn't much to be buying in their third quarter, fiscal third quarter, in terms of new products. So are you hopeful for the innovation to come?
Yeah, but in the case of Apple, a lot depends on the iPhone cycle, and largely because as your guest previously alluded, it is the biggest portion of revenue for them. So the smaller products really don't move the needle as much. It's really at what pace do people upgrade their iPhones, and it's going to be fun because in the next quarter we're going to see a brand new version come out, and that's going to set them up for a nice holiday season too, assuming that the macroeconomic conditions globally don't get worsened from here.
Hey, Anurag, what is the most surprising part of Apple's report here?
To me, the comments about supply chain, because I really was going into the quarter thinking that supply chain actually worsened during the quarter because of COVID restrictions in China, and the parts weren't available or the assembly wasn't available. That was my thought process going in. But based on Emily's comments, it looks like things eased up a little bit. Now, that to me is the number one positive announcement that came out of this release.
Are there also some signs here that some of the headwinds that they had faced are now really starting to come down? You have Tim Cook saying that he expects revenue to accelerate in the fourth quarter despite some softness, he says. So have they turned a corner in many ways?
So the way I think about it is, we were expecting, acceleration in the next quarter on a constant currency basis. We were expecting a headwind because of currency, but I don't see them going into double-digit revenue growth again over here. I think even if there is revenue acceleration, it's still going to be single digits, and in fact, it's possible that services growth may slow down even more going into the next quarter, but. Overall, I can't find that many mistakes at this point, largely because of the supply chain issues.
Anurag, how should we think about the iPhone upgrade cycle in a time when consumers are paying so much more for gas and so much more for groceries? They're not necessarily, in my mind, going to switch out of the Apple ecosystem and go to an Android phone, but does it mean they hold on to their iPhone 10 or iPhone 11 for maybe an extra year?
Yeah. Tim, I did see your question, from a previous guest also. But, unlike the other retail world where you can, water down and go to a discount store and buy things, you're not going to give up your phone and go to an Android. And I think the same is case for a Samsung high-end user. You're not going to leave Samsung and go to an Apple phone. But frankly speaking, what happens is the Apple has such a massive install base of iPhone users that let's say that number is closer to 800 million units. Every year, and the average life of refresh cycle is about 4 years. So every year they're going to sell about 200 million units anyway. It's a question of in really good times, they're going to sell a little bit more, and bad times they're going to sell less. So yes, you can push the cash flow out by a few months, but that doesn't change the fact that whenever you upgrade, you're still going to stick with an iPhone.
Anurag, I don't really like all the comparisons to Androids and Samsung. Some of us still enjoy some BlackBerries every now and then as we think about the pivot to the iPhone. But we'll get serious.
You're the only one, Taylor.
And stay serious with you for a moment.
We've all
Cash
pivoted.
Neutrality. How do you think about a company generating $23 billion in operating cash flow, the use of cash that comes from that as they try to maintain the cash neutrality?
Yeah, I have made the argument that they should actually buy back far more shares in this environment when they are depressed because of the ongoing macro conditions. But the share buyback was in line with what they have done in the last couple of quarters, so not much there. But I really hope that they accelerate that plan, because as you said, they are so far away from that cash neutral position that they can easily go another 30-40% without a problem.
All right, so Anurag, based on what we got from Apple, is this a company thinking about a recession? Because here we are when we talk about macro, recession, no recession. We got the disappointing GDP. Based on what we got from Apple, is this a company that indicates maybe a recession is coming?
Now, I have been surprised. I've said there are 4 amazing business models that operate in the United States, and all 4 of them have reported really spectacular results over the past few days. Apple is a brand that envious to any company from any country. So I really think I think they've turned a corner over here, but not because of so much of demand issue, but because of supply chain issues.
What about Anurag, the services number? Help us read into that, miss.
Yeah, I mean, it is double digits. It is really facing tough comparisons. It is not easy to come up with double-digit growth in that area for a very long period of time. We saw some really strong numbers from the pandemic. It's only going to get a little softer from here in our view, because you're not downloading as many games. You're not, payment volume's going to go down later. So the way I think they're going to expand that is they add more services. They add more, let's say, TV content and other things, because to me, that's really where the investment should go to, and not in a car or anything, but we can talk about that later, because this is a very high margin business. These are, gross margins for services business is 70%. It is truly the right place to be.
Pretty remarkable. Anurag Rana, thank you so much. Team leader, technology, Bloomberg Intelligence, breaking down those Apple earnings. And we continue to see Apple shares rallying in the after hours, pressure on Intel. But Caroline, let's talk about what's going on with S&P 500 mini futures and NASDAQ 100 futures, because folks, they are rallying.
They are. Let's look at the futures market up another 2% when you're looking at the S&P 500 mini. When you're looking at the NASDAQ, 2.2%. No wonder when the most valuable tech stock in the world, or publicly traded, Apple, is trading higher after hours. When Amazon is up so much, I mean, put Intel to one side, this really is a story of strength. And as you so rightly said, not really companies talking about a recessionary environment here, Taylor.
Well, and I want to be careful with my words here. We talked a lot about the K-shaped recovery out of COVID. I'm wondering, this quarterly earnings report season feels similar. You have companies like Apple, Amazon, juggernauts, able to get it done, crushing it. The after hours market shows that, Tim. And then you have other companies, of course, still sort of struggling, whether it be supply chain, inventory that we've talked about. There seems to be a big divergence on those who are able to get it done and navigate and those who are not.
Yeah, and a really big divergence when it comes to customers, too. Brian Niccol of Chipotle telling us yesterday that they've lost, as they've raised prices, they've lost some customers in the lower end of the income spectrum. Those customers have traded down. Meanwhile, perhaps the iPhone-owning customers, right, the wealthier customers, they are trading down from restaurants to go to Chipotle. So we're seeing this play out on a lot of different levels here.
Yeah, but right now we're seeing play out in the aftermarket, and investors are getting ready, maybe potentially for some more rallying into the trade for Friday. All right, guys, we got to run. Covered so much ground. Apple, Amazon, Intel, Roku. These are all trading in the after hours following their earnings. That's going to do it. That's a wrap for Beyond the Bell, our extended simulcast on this big earnings Thursday. Do be sure to catch us again, same time, same place on Friday.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Carol Massar. We're live in the Bloomberg Interactive Brokers studio. Want to get over to Charlie Pellet because he's been watching everything that's been happening after hours, and he has been busy. Hey, Charlie.
Indeed, and here's what's going on. Let's begin with Apple as we recap, reset here. Third quarter results that narrowly beat Wall Street estimates, easing concerns that supply chain snags and a shaky economy would ravage the tech giant sales. Apple after hours up by roughly 3%. Amazon reporting revenue that beat estimates, also gave a strong sales forecast for the current quarter. Right now, Amazon surging after hours, up by 12%. And Intel fell far short of analysts' second quarter sales and profit estimates after hours, looking at Intel down now by just about 9%. Turned out to be an up day on Wall Street today with the Dow, the S&P, and NASDAQ all rallying. 7-week high on the S&P, up 48, gain there of just about 1.2%. The Dow Jones Industrial Average up 332. That is a gain of 1%. NASDAQ also advancing today. The NASDAQ Composite Index up 130, higher by about 1.1%. 10-year yield 2.66%. 2-year yield 2.86%. Gold up 1.3%. 17.56 the ounce. West Texas Intermediate crude lower now by less than 0.1%. Little changed. 97.23 a barrel. I cannot ignore Roku after hours. Roku shares, they are plunging right now by 26%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, a lot after the closing bell. All right, Charlie, thank you so much. Well, among our most read on the Bloomberg, we talked about it earlier, about a story that has to do with an entire Manhattan block that's frozen in peak pandemic time. It turns out to be the block that we reside on, 59th Street and Lex, an entire block of vacant storefronts. So we thought, we got to get a check on New York City real estate.
Yeah, I made the comment to you, Carol. We're not seeing it play out when it comes to residential real estate, right?
No.
The vacancies when it comes to commercial doesn't seem to have any sort of connection to the high prices in residential. Let's go to Francis Katzen, the founder of the Katzen team at Douglas Elliman. Francis joining us on the phone from here in New York City. Francis, how are you?
I'm well, sir. How are you, Tim?
We're doing well. Thank you so much. Well, give us an idea of what you're seeing in the residential market in New York City right now, because it's kind of wild. We've got people working from home. Oftentimes people, if at all, maybe coming in 3 days a week to work. So we see these pockets, like in Midtown, where it seems like retail is dead. But look at the residential market. It's been on fire.
It is so true. There's such a disconnect between the commercial and the residential. The residential has seemed to actually outperform expectation all the time, even amongst a 9.1% inflation, even amongst interest rate hikes. We're seeing such an interesting sort of a pattern. This year alone, condo median sales prices are up 14.1% against last year, which was the run-up, inverted commas. So there seems to be this really niche demand for people wanting to diversify from their portfolio back into real estate because there's been a capitulation over the past couple of months.
So, Francis, are they just buying real estate as an investment and not living in it? Or, what's going on? I'm trying to understand the disconnect. Are people are buying real estate and they're living there, working from home, but they're not going out shopping, which is why all of the retail that's out in front of Bloomberg, the tenants have not, nobody new has moved back in.
That's actually a really good observation. So what's happened is that you've got two types of buyers. You've got people who want to actually diversify with 1031 money, buying into these homes and actually getting an absolute sugar high on their rentals. The rental market is up 40% year over year with less than 2% vacancy rate, with an average trading price for a studio of $4,000, which means that it's on a sugar high like no one's seen, which is allowing people to get a pro forma into effect that gives them a good rent roll. The end user is also taking advantage because although the rates have gone up, there's still this potential value because when there's uncertainty, there's negotiability.
Yeah, it's amazing. So what about when it comes to foreign buyers here? Because at the higher end, foreign buyers historically have helped keep that market really hot. What have we seen over the last 2.5 years as much of the world closed? And, we've seen people not travel between their home countries and New York as much.
That's a really good observation and correct. What we saw was a very big change during COVID because there were some countries that were not going to be compliant with the FDA COVID requirements coming back into the U.S., such as China and Russia. And so what we had was very specific buyers coming in. Now what we're seeing, since the floodgates, if you will, have opened up, we've got a nice return of cash from overseas. A lot of people are coming into the luxury sector. That's luxury meaning over 4 million. This past week, we saw 21 contracts signed, which is 8 contracts up above the week prior, So we're seeing a lot of people wanting to come back and park their cash in New York. And it is foreign money. It's all over the world.
So,
I'm dealing with it.
Francis, you've seen a lot of cycles, right? Like in the real estate industry. When you start talking to me about sugar highs and so on and so forth, I know that was on the rental space, but when we start seeing prices like this, to me, it says it's getting a little bit hot, and at some point, this has got to cool.
Well, the sales market will adjust, and I think we're seeing that now. I think right now with the GDP at a negative 0.9%, some would say that we are in a recession, some would say we're not. But what I'm seeing is that the market has cooled on its price per square foot performance, but the velocity has changed by simple virtue. There's not a lot of inventory right now because people don't want to sell down on their assets. So there's this pent-up demand for the remaining prospects who want to get in and get out of paying sugar-high rental and get back into owning equity.
It's interesting. Your listings, Francis, really run the gamut. On the one end, you've got something at $499,000, a one bed, one bath in Kips Bay. On the other end of the spectrum, you've got a $65 million apartment listed. That's a 4-bed, 3-bath. Where are you seeing any signs of slowdown right now? Because you have the entire spectrum when it comes to listings. Are you seeing any part of it slow down?
That's such a great question because you are seeing such a breakdown on segments. The entry market is the most impacted because they need the most compelling interest rate in order to buy in. With not a lot of wage growth, it's very tough to make, when you've got such high rental markets and people wanting to get out of being extorted on that, they want to own equity, but it's really tough. If the rates are going up, it squashes that segment because they have the least to spend and the most to lose. On the luxury side, they're not so dependent, neither is foreign money, on necessarily an interest rate. So you're finding that these particular customers are ready to play and are coming in to get a deal. And there's a conversation to be had between the extreme of what we want to achieve on the sale price and where the buyers feel inherent value is.
What about in terms of real estate evolving post-pandemic, in terms of the type of homes that people want to live in? Are we continuing to see that change a little bit or no?
No, we are. That's a very good observation. Yes, we are seeing people wanting to take, look, the commodity in New York is the commodity of space, right? So if anybody can get in now and get more rooms for the same price that they might have been paying when we were in a very high price, per square foot market, I think everyone is very seduced to get in and take advantage, especially in New York City specifically.
You've also got rentals. So I'm wondering what you're seeing at the rentals that you have listed right now. I've seen, I think we've all seen the TikToks and the Instagrams of people waiting in line to get
Here's
in.
Here's a Fifth Avenue for you. It's $140,000 monthly.
Okay, I'm not.
815 Fifth Avenue.
Okay, wow. Yeah, that's something. I don't know if there's a line out the door there.
Yeah.
Help describe the rental market right now, because if you're a renter, if you're just moving to New York, you're in a tough spot right now.
Very. I mean, can you imagine trying to rent a studio for $4,000 a month and you have to be able to show 45 times the asking rent in their account?
It's brutal.
It's insane. And most of these guys don't realize just how fast the product's moving. It's not like you walk in and take a week and a half to think about it. Product is getting snapped up within hours. There's a stat right now on Jonathan Miller, on the Miller-Samuels report, that shows that product on the market for less than 9 days. I would venture to guess right now, product is on the market for less than 3 days on average. It's that fast. People are basically taking it sight unseen, trying to get their paperwork clamoured through, and then basically we do a Skype and it's done.
We were talking about who is buying in foreign money. I mean, is it all financial money? Like, who is it?
These are families. These are families that want to park cash outside of their, domain, whether it's India, whether it's Asia, whether it's...
is it Russia?
Not a lot.
Okay.
Not a lot. It's very hard to get it out, I think, right now. I'm not seeing that. I'm seeing a lot of... other markets, and it's all cash. I mean, we're doing a deal right now where it's, someone's basically offering $34 million per apartment they want to buy two in cash. So it's happening.
I've got to say, we have an amazing team that puts our show together, and then we're all looking at each other like, who are these people?
Well, we don't work with them because they don't work.
Who have saved their shekels.
They have saved their shekels. I would say so. Francis, this was fun, and you gave us a great snapshot of what's going on, and it's pretty amazing. Like, we started our broadcast talking about recession, no recession, and then now we're talking about, people who are buying two $35 million apartments or whatever and putting them together. Francis Katzen, thank you so much, founder of the Katzen team over at Douglas Elliman, on the phone in New York City. Maybe this is better, a townhouse. Hudson Square, $45,000 a month.
There's a townhouse in Brooklyn I saw that was $9K a month for a rental, which for a 5-bedroom, that's not crazy.
I bet you get some outside space with that.
You do, I checked.
Yeah, there's some really cool things. Mercer Street, I'm looking at it. Fifth Avenue, $38,000 monthly.
Yeah, we can look.
I'm kind of lost. I've gone down a rabbit hole. All right, guys, that'll do it. We still have some more economic news tomorrow, but man, watch those futures in the aftermarket. A lot going on this Thursday. Get ready for Friday. This is Bloomberg.
Innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, a record June quarter for Apple, beating on revenue despite headwinds from a strengthening dollar, China lockdowns, and an expected slowdown in consumer spending. The iPhone also topping estimates, but supply constraints hitting the Mac and the iPad. I spoke to Apple CEO Tim Cook, and we'll tell you what he had to say. Plus, Amazon surging in late trading after providing a strong outlook for the third quarter, a much different forecast than other retailers. Net sales jumping in the second quarter, in part thanks to Prime Day shoppers. We'll dig into the data. And the largest chip maker for mobile devices is warning of a slowdown in spending. We will ask Qualcomm CEO Cristiano Amon about the company's weaker than expected forecast, the CHIPS Act, and China. He's my guest later this hour. all of that in a moment. But first, I want to get a look at the markets and another big day for tech results. Apple and Amazon out after the bell, and we're seeing some green. Ed, Bloomberg said Ludlow.
This is the day we've all been waiting for. Apple up 4%, narrowly beating on the top and bottom line. Strength in iPhone, iPad. It missed on Mac wearables. Interestingly, it missed on services as well, which was an area analysts hoped would be an area of strength. It looks like the affluent consumer, the rich consumer at the upper end of the market's holding up well. We've had that conversation with Tim Cook, which we're going to go into detail, but macroeconomic headwinds in the third quarter. Go to Amazon. Amazon, there is no doubt, surging in after hours. Frankly, on a very strong outlook for the third quarter. Overall, net sales beat. Pockets of strength, ironically, in brick and mortar. Online sales missed. North America a beat, but strength in AWS, strength in advertising. A lot of staying power for Amazon, showing that it has room to grow. Look at that, up almost 13% in after hours. Really interesting, because the opposite of what we saw from other retailers like Walmart and Target, who preemptively cut their outlooks on concerns consumers were shifting their spending from discretionary to essential items. But there's this idea, right, that the shopper on Amazon and the Prime subscriber